If you woke up this morning, opened your phone, and saw the familiar headlines. Bitcoin crashed again. Markets in panic. History is repeating itself. I want you to pause for a moment, take a breath, and listen to me. Speaking as someone who has worked in the U.S. financial industry for decades, what we are witnessing is not a collapse of Bitcoin. What is truly collapsing is trust in the traditional financial structure. Nasdaq, MSCI, the indices. All of these are just the surface. They're like gauges on the dashboard of a machine that has been running for far too long. The real question lies much deeper, and it's the one keeping people on Wall Street awake at night. What happens when major corporations no longer trust the US dollar? Bitcoin is not the cause. Bitcoin is merely the mirror reflecting that problem. Let's talk about strategy, what many still know as MicroStrategy. I want you to understand one thing clearly. This is no longer a company in the traditional sense. It is a statement. Michael Saylor did not invest in Bitcoin the way a retail investor buys and sells on an app. He redefined the role of a corporation within the modern monetary system. Strategy is not trying to beat the market. They rejected the rules of the current system altogether. The 660,000 Bitcoin they hold are not just assets on a balance sheet. They are a stance. And that is exactly what terrifies Wall Street. Because if this model works, thousands of CFOs across the United States will be forced to confront a very uncomfortable question in front of their boards. If they can do it, why are we still holding cash? This is not fear of price volatility. This is fear of precedent. Over the course of my career, I've witnessed many financial cycles. I've seen bubbles. I've seen crises. And I can tell you this with certainty. The biggest changes never begin with price. They begin with belief. And that belief is shifting slowly but irreversibly. And that is why this is not a story about Bitcoin. This is a story about corporations quietly abandoning the old money and preparing to step into an entirely new system. In more than 30 years of working with the U.S. financial markets, I've learned one critical lesson. Markets rarely collapse because of a single asset. They collapse because a belief model stops working. And right now, we are witnessing a conflict between two capital management models. The old model, very familiar. Cash, bonds, low yields, complete dependence on Federal Reserve policy. This model worked well for decades, but it was built on one assumption. That money would preserve its purchasing power over time. The problem is, that assumption is breaking down. On the other side is a new model. Still imperfect, still controversial, but crystal clear in its principles. Scarce assets, no intermediaries, cannot be printed, cannot be bailed out. Strategy is not betting on Bitcoin. They chose a different capital management model because the greatest risk for businesses today is no longer short-term volatility, it's long-term loss of purchasing power. This is why Wall Street truly fears strategy, not because Bitcoin's price goes up or down. If strategy fails, the market will call it an individual mistake. But if strategy succeeds, it becomes a precedent. And precedent is something the traditional financial system cannot control. I want to make one thing very clear, something the media often ignores. Strategy is nowhere near bankruptcy risk. By U.S. corporate finance standards, their debt is long-term. Leverage is low. Cash flow is controlled. And they can withstand an 80% drawdown for years without forced liquidation. This is not the balance sheet of a reckless company. This is the balance sheet of a company preparing for a long-term cycle. So what about Nasdaq? Nasdaq is not anti-Bitcoin. They are not attacking strategy. They are simply defending the old definition of what a technology company is supposed to be. If strategy is removed from an index, it's not because they're weak. It's because they no longer fit inside the old box the market is used to. And here's what market experience has taught me. Forced selling does not destroy value. It only redistributes ownership. When passive funds are forced to sell, who buys? Not panicked retail investors, but sovereign wealth funds, family offices, long-term capital from the Middle East. Those who don't think in quarters, but in decades. Weak hands sell. Strong hands buy. History repeats itself that way. But Nasdaq is only a small chapter. The bigger story lies with MSCI. When MSCI considers removing companies with large crypto exposure from global indices, the objective is clear: to isolate Bitcoin from passive capital flows. But every attempt at isolation in financial history leads to the same outcome. A parallel system is formed. If excluded, Bitcoin-focused companies don't disappear. They create their own indices, their own ETFs, their own benchmarks, no longer dependent on the US dollar. This is not rebellion. This is evolution. In US history, corporations have always recognized monetary risk before the public. Before 2008, large institutions exited long before the crisis erupted. Bitcoin treasuries today serve the same role. They are early signals of persistent inflation, of eroding trust in monetary policy, of the gradual weakening of the dollar's purchasing power. This is not a retail investor revolution. Retail reacts to price. Corporations react to systemic risk. 78 companies are not FOMO-ing. They are defending their future. And when you look at Bitcoin's real supply, not the numbers on paper, you'll understand why this trend cannot be reversed. Supply is extremely limited. Corporate demand is growing exponentially. Indices can change. Prices can fluctuate. Media can spread fear. But trends do not. Corporations are leaving the US dollar and moving into scarce assets. There is one very important point I want to spend more time on because it is often misunderstood, even within professional financial circles. When a company like Strategy moves a large portion of its balance sheet into Bitcoin, many people call it a bet. But in the language of risk management, a bet means putting yourself in a position where you can be forced to act at the worst possible moment. Strategy is not in that position. They are not borrowing short-term to invest long-term. They are not relying on speculative cash flows. And most importantly, they are not forced sellers. Over the course of my career, I've seen many companies collapse. Not because the assets they held were bad, but because their debt maturities did not match the market cycle. That was one of the painful lessons of 2008. And Strategy appears to have studied that lesson very carefully. What confuses Wall Street is this. This model is not easy to attack. You cannot bankrupt Strategy with price volatility alone. And you cannot force them back into holding cash. And when familiar tools stop working, the system turns to rules. This is where indices come into play. Nasdaq, MSCI, S&P. Indices are not just measurement tools, they are capital distribution gates. When a company is removed, passive capital is forced to exit. No emotion. No judgment, just mechanics. But once again, market experience has taught me this. Forced mechanisms always create entry points for long-term capital. When passive funds sell because of rules, the buyers are not panicked investors. The buyers are institutions that have been waiting, those who understand they don't need liquidity tomorrow, next week, or even next year. This is why removing Strategy from an index, if it happens, does not end the story. It only changes who owns the company. And here, we reach an even deeper issue, the US dollar itself. For decades, the USD has been the standard. Not because it was perfect, but because there was no viable alternative. But in finance, an alternative doesn't need to be perfect. It only needs to be more reliable over the long term. Bitcoin does not promise short-term stability. It promises long-term discipline. For businesses, especially publicly listed companies, the greatest risk is not price volatility. The greatest risk is losing the ability to plan because the purchasing power of money changes too quickly. When you are a CFO, holding cash is no longer safe if you don't know how much real value it will buy in 5 or 10 years. This is why more and more companies are beginning to view Bitcoin not as a speculative asset, but as a long-term store of value. I've spoken with many CFOs over the past few years. They don't appear on television. They don't post on social media. But behind closed boardroom doors, the same question is being asked more frequently. If we do nothing, is the risk greater or smaller? And that is the moment when a trend is formed. Not from retail buyers. Not from media headlines. But from slow, cautious, defensive decisions. A Bitcoin treasury is not a rebellious statement. It is a corporate survival reflex in a changing monetary system. And once you understand that, you'll start to see headlines about indices, sell-offs, and crashes very differently. Not as fear, but as signals. There is one thing I want you to remember, especially if you've lived and invested through multiple market cycles. The biggest changes in finance never arrive with noise. They arrive in silence. When the media talks about indices, rebalancing, or the possibility of being removed from Nasdaq or MSCI, they are looking at surface-level movements. But smart money always flows beneath the surface. I've seen this many times before. In the years leading up to the 2008 crisis, the most important decisions never made the front page. They happened behind closed doors, in boardrooms where large institutions quietly adjusted risk long before the public realized something was changing. What we are seeing today with Bitcoin treasuries feels very similar. When a company decides to hold Bitcoin, it's not for 1/4 of earnings. It's for a far more fundamental question. What do we believe in over the next 10 or 20 years? Do we believe in unlimited money printing? Or do we believe in a system with clear, enforceable limits? This is not an emotional choice. It is a strategic one. And once that choice is made, short-term volatility, whether from markets or from indices, loses much of its meaning. It becomes noise, not signal. What many people still don't realize is this. Being removed from an index does not make a company disappear. It only determines who is allowed to hold that stock by rule. Long-term investors, those not constrained by indices, are still there, and they often see moments like these as opportunities. That is how ownership has always shifted throughout financial history, from those who are forced to sell, to those who are able to wait. And when you put all the pieces together, corporate balance sheets, the gradual erosion of monetary purchasing power, changes in index structures, and the emergence of parallel financial systems, the picture becomes very clear. This is not a debate about Bitcoin. This is a discussion about trust. Trust in money. Trust in institutions. Trust in the ability to preserve value over time. And history shows that once trust begins to shift, it does not return to its old position. It only continues forward. Slowly, but inevitably. That is why the most important thing right now is not predicting Bitcoin's price next month or next year. The most important thing is understanding where you stand within a long-term transition. Because those who recognize change early are not always the ones who make the fastest profits. But they are often the ones who protect their value best when the old system begins to lose stability. And from this point on, the question is no longer, is Bitcoin volatile? The real question is, as trust in the old monetary system continues to erode, where will you choose to stand? At this stage of the market, I don't think the most important thing is that you agree with me. I also don't think you need to like Bitcoin or believe it will surge dramatically in the future. What matters far more is that you understand what is really happening. Because if you've been around markets long enough, you know this. The biggest changes never arrive with alarm bells. They come quietly, step by step, while most people keep staring at familiar numbers and assume everything will eventually return to normal. Over more than 3 decades working in U.S. finance, I've seen many systems once considered solid begin to weaken. Not because of a single shock, but because trust eroded over time. The U.S. dollar didn't disappear overnight. But its purchasing power has changed, slowly and continuously. And when corporations, institutions responsible for safeguarding billions in capital, begin adjusting their balance sheets, it's not an impulsive move. It's a response to a reality they see very clearly. Standing still is also a risk. Today's story is not about how high or how low Bitcoin might go. It's about what you choose to trust to preserve value over the long term. Do you trust a system that can change the rules at any time? Or a system with clear limits, even if it comes with volatility? There is no single right answer for everyone. But there is one thing I believe is true for all of us. Don't let short-term headlines dictate your long-term thinking. If this video helped you see the market a little more clearly, even just a little, consider subscribing to the channel. Not to chase trends, but to better understand what's happening behind the numbers. And if you have thoughts, doubts, or questions, especially the ones you don't hear discussed on television, leave a comment. I read them. And many future videos are created directly from those questions. We are living through a transitional phase of the financial system. Not loud, not dramatic, but deeply important. The final question is not what the market will do. It's how you choose to understand it. Thank you for your time. We'll have much more to discuss in the videos ahead.